Hello traders, this is Dave with the Compass Options Trading Room and Alert Service. And this is going to do this is going to be a fairly quick video. Basically, I wanted to cover the one type of trade that I take over earnings that will generate consistent profits for you. Trading over earnings is very difficult. It's got to be very specific, and we don't have any idea where the stock's going up, down, and by how much. So I'll show you how I do these time spreads. I call them time spreads. They're calendar spreads that have specific expiration dates. So let's move on here. Again, this is David. I'm with the Compass Options Trading Room and Text Alert Service. I have a trading room that I trade, call out trades, and talk to all of our members 5 days a week, from market open to market close, Monday through Friday. And I also have an alert service where the trades that we take, the highest probability trade setups, are sent out to our alert members whenever we take those trades. We send them out for when we enter, and we send them an alert out when we're going to exit. So let's get the disclaimer out of the way first. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose, and neither myself or Right Line Trading are licensed financial advisors. All right, so here we go. This is basically just a graphic of what the alerts look like when you get them on your phone, and they're basically just come with all the information that you need on the alert that we're taking. These time spreads that we're talking about will some of the alerts that you'll get. We do obviously do other types of trades in the room, but this is the one I'm going to focus on tonight. So in the room, and as far as our alert service, we have rules to trade by. We trade what we call trading the best and skip the rest. We have certain criteria for this. This means we only take the highest probability trade setups, which means we're only getting into trades that the institutions are in. We're not trading when there's just retail traders in there. We're only trading when the institutions are in there. And the second rule is our objective is not to make trades. Our objective is to make money. We don't make 20 trades a day. We might take 2 or 3 trades a day. It might take 0 if there isn't any good setups. And it might take 4 if there's good setups. But we don't trade a lot. We're just looking for the very highest probability trade setups. And we have a really nice high win rate because of that. And you can make a lot of money doing that. And as profitable traders, we need an edge over all the other retail traders. And we have basically 4 criteria. We have other criteria, but the main ones is we use the Right Line Compass system, this piece of software that lets us know when the institutions are in the trade. We also trade relative strength and relative weakness. And this is not RSI. This is when we watch a stock, we want to know if it's outperforming the SPY on the 5-minute chart that day. So if the SPY is going sideways or down and the stock is stacking green candles, it has relative strength. And so that would be give us a bigger edge. As long as the institution's in there, it gives us a bigger edge, because if the market does start to flatten out or start to go against us, our stock is going to outperform the SPY, which means it gives us plenty of time to get out with a profit or a small loss, even if it turns against us. We also want to trade with the market trend if there is one. There isn't always a market trend. You can have choppy markets. And if that's the case, then we're going to be focusing on the individual stocks and taking the very best stocks, either long or short. If the market's only going chopping around. If the market's trending up for the day, we'll focus on longs. Trending down for the day, we'll focus on shorts. And all our trades in the room we do intraday trades, but we also do overnights and short-term swing trades that can last up to 2 weeks or so, 3 weeks of the outside. We also do put credit spreads and things like that. So we take a lot of trades, but I'm going to focus on just one of the particular strategies we use tonight. And again, buying and support and sell at resistance. This is important, not to chase stocks on the way up or on the way down. Wait till they come back to a support level and then confirm that they're back into the original trend and then enter. So you're getting in at a very good price. All right. So these time spreads we're going to talk about, these are the ones I've done this year so far. These have all been alerted on, and we've taken these all in the room. We've had 12 wins and 1 loss, so 12 out of 13 for 92% win rate. Had you invested 2,000, and I'm just using this as a rough number. I have to have something to use to give me an idea of what profitability is. But if you invested 2,000 in each time spread, It's produced a $7,325 profit so far this year. Just this one particular, this one particular strategy. All of our strategies in the room this year, I think we're up about 25,000, I think, in the first 2.5 months or so. But so these are a kind of an example of what we can expect for percentage gains on these time spreads. And again, these are pretty quick trades. We usually get in on Thursday, on the night before earnings, and I'll go over this. We get in the night before the earnings occur, whether it's after the open or before the open the next morning. We take the trade, 2 o'clock, 3 o'clock in the afternoon, and then we're out the next morning if we get our profits. But we had Las Vegas Sands, and you can see where these are clustered into January because that's when earnings starts, the third week in January or so. So we got Las Vegas Sands 35%, Western Digital here 39%, AMD 21%, Royal Caribbean 50%, 40% for Bristol Myers, Fortinet 50%. It's pretty nice gains here. We took a loss in Disney. You're going to get some losses sometimes if the stocks go way outside of the range that they're expecting, that the market makers are expecting. Pepsi 26, W 32, Marvel we did just recently 37, Path we just did last week 67%, and we did Groupon just this past Thursday, and we got a 50% gain overnight. We get in this like at 2:30, 3 o'clock in the afternoon, and we get out the next morning about 9:35, and a nice 50% gain. So again, 12 wins, 1 loss so far on time spreads. And again, this is the one strategy that I use in the room and for the alert service to take profits over earnings, to be consistently profitable. Very difficult to trade earnings. So let me kind of go over what we look for. So again, time spreads is the only strategy I use over earnings. And it's obviously on stocks that are reporting earnings after the close that day, but before the opening the next morning. So we're just getting into these trades just before they report. So we're not multiple days ahead of time. We're just doing the day before they report. So again, we put the trade on just prior to earnings being released. And the whole point of this trade is the trade is meant to capture the difference in the implied volatility crush and the time decay between this week's and next week's options. Now we'll talk about what implied volatility is here in just a minute and what IV crushes, but this is what the trade is doing. So it's a non-directional trade. We don't care whether the stock goes up or goes down. That's what makes it so nice. As long as it stays within a specific percentage that the market makers are expecting, then we're going to make money because we're going to capture the IV crush when the earnings comes out. And again, this trade works best on stocks that historically don't exceed their expected move after earnings release. So harvesting premiums from the options can be profitable. So if the market makers are expecting a move, let's say they're expecting a move on the stock of 12% up or down, if it stays within the 12% to the upside and 12% to the downside, then we'll make money on the time spread. If it jumps outside of that range, then we have to make some adjustments to the trade. But that's what we're looking for. And most of the stocks don't. I'm only taking stocks that historically stay within the expected spread 80% of the time or more. And again, time spreads, they're entered for a debit, and that is the total risk on the trade. It's completely defined risk. You can't lose any more than what you paid for the spread. And they should be entered and exit as one transaction. And I'll show you how we do that. All right, so these are time spreads, and this is an earnings trade. I do this only for earnings. Say time spreads, they're initiated on a stock reporting earnings tonight or tomorrow morning before the open, and it consists of selling this week's expiration at the money calls. You can do puts, but I use calls. So you're going to sell this week's expiration at the money calls. So you'll be selling this Friday's calls and buying next week's calls using the same strike. All right, and this is going to be done for debit. So let's say you were taking a trade on Monday for a stock that was reporting Monday night or Tuesday morning. You'd be basically selling the calls for next Friday, all right, which would be what, the 22nd. Yeah, so you'd be selling the calls for the 22nd and buying the calls for the 29th, actually the 28th, because the 28th is 29th is a holiday, but that's what you're doing. So you're selling this week's calls and buying next week's calls, all right? And the reason we do that is after earnings are released, the implied volatility is going to be drained out of the this week's and next week's options. However, the implied volatility is higher for the current week options versus next week's options because this week's options are closer to the closer to expiration. So the implied volatility that's in a trade, that's in an option, the market makers are jacking up the price of the premiums on all the options that before earnings comes out because they don't know how much it's going to move or which direction it's going to go in. So to protect themselves, they move the premiums on those options way up. As soon as the earnings come out now, the extra premium that they had put in there, or what's called the implied volatility, is going to be crushed. In other words, all that premium is going to come out of there, and our job is to capture that premium. Also, another way that this makes money is the time decay is going to impact this week's options more than next week's. So the current week's options are going to decay much faster than next week's. And since we've sold this week's calls and bought next week's calls, the ones we've sold for this week, the decay is going to come out of those faster so we can buy them back cheaper. And so what these two things together do, between the implied volatility or the IV crush, plus the time decay difference between this week and next week's, that's what gives us the profit on the stock. And again, we don't care which way it moves. So this is going to allow us to buy back this week's options and sell next week's options options for a profit of about 15 to 50% normally. Sometimes it's probably generally more like 25 to 50%, but sometimes you only get 15. It just depends. So that's what we're doing. And typically this only lasts, we put it on overnight and it's taken off the next morning. And we have really, really good results with it. Again, it's a defined risk. You can only lose whatever you paid for the premium for the time spread. And generally, you're not going to ever lose 100% of it because there's usually always some premium left in the calls at the end of the day. Okay, so let's talk about what is volatility crush and what we're harvesting here, how we're making money in this trade. All right, volatility crush is the additional premium that's included in the options prior to earnings due to the uncertainty of the stock price reaction to the earnings report. So the market makers don't know which way the stock's going to go. They don't know how much it's going to go, but they have to price the premium somewhere. So they put in what they're expecting. So let's say a stock is 100 and they think it's going to move up. They think it's going to move 10%. So basically they're going to jack up those premiums. So if the stock goes up to 110, down to 90, in other words, it's moving 10% either direction, they're going to be protected. And the premiums in there, if anybody bought calls or bought puts, they're going to lose money on. But if you're selling the calls for this week and buying the calls for next week, because of that implied volatility crush that comes out of the calls when the earnings are announced, we take advantage of that and we make money on it. Again, immediately after the earnings release, the additional volatility that was included in the option premium drops rapidly or is crushed, and that's where volatility crush comes from. So what happens is, if let's say we paid in a case of the one we just did last week for example, on Groupon, we actually sold the March 15th 1850 call and bought the March 22nd 1850 call, and we did it for 20 cents. It only cost us 20 cents for that spread, and we sold it the next morning for 30 cents. So if we bought 10 of those, for example, it would have cost us $200 and we would have got out for $300. So again, that's a pretty big profit. It's 50% profit. And again, if you put 2,000 into that, you would have made $1,000 on that particular trade. And I'm always selecting stocks that have specific criteria just prior to earnings. The volatility can be crushed for nice profits, but it's really important. The really key to this thing is knowing how to find the stocks that qualify, because a lot of stocks that do not qualify, and that's my job, is to find these stocks that are coming up on earnings, that have earnings tonight or tomorrow morning, and find only the ones that I feel have the highest probability of being successful, and those are the ones that we take. So again, the majority of the trades will be calendar spreads. All of these will be time spreads. The structuring of the trade is we sell this week's options expiration and buy next week's option expiration at the same strike price. So if you're buying a $100 call or selling a $100 call for this week, you would buying a $100 call for next week. And they're typically right at the money. I usually do them at the money when we put the trade on. Again, the time spread is structured to capture the implied volatility drop after the earnings are released. And the difference between this week's options volatility and next week's options volatility is what makes us money. And it also captures the difference between this week's time decay and next week's time decay. This week's time decay decays faster than next week's, and this week's volatility is going to drop more than next week's volatility. So since we've sold this week's calls, that means those calls that we sold, we can buy them back a lot cheaper than what we collected when we sold them. And again, we enter the trade just prior to earnings release. In other words, enter the trade the afternoon before an earnings release occurring after the close or before the open the next morning. Again, we try to take 20 to 40, sometimes 50% after the open in the morning. The take profit order should be active before the market opens. So when you put this trade on, let's say put a trade on like we did on Thursday afternoon, 2:30, 3 o'clock, I have an order working. We had an order working in it for 30 cents before the market opened. So we put the sell order in on Thursday after we've filled on the trade, and we have it good to cancel, so that stock, that order, that sell order is working when the market opens 9:30 in the morning. That sell order is out there working. So if you get a big jump all of a sudden in the morning, or a big drop in the volatility crash, we can take profits. I mean, sometimes we'll get them, 9:30 in 30 seconds right after the market opens. So that's how I make money on over earnings. It's the only strategy you use over earnings. I don't try to guess earnings because you can't. You try to outguess the market makers. Forget that. It just doesn't work. All right. So the criteria that I use for these time spreads, what I look for, obviously, they got to have weekly options. I mean, first thing, they have to have weekly options. I can't take a time spread of the trade and sell this week's and buy next week's if they don't have weekly options. The stock has earnings announced after today's market close or prior to the market opening tomorrow morning. And so basically, when I put the trade on, when the market becomes active again the next morning, the earnings will be out already. I look for implied volatility between this week's option and next week's option. Has to be a large percentage difference, 40% or more. So you might have a stock that's got implied volatility this week of 60 and implied volatility next week's of 30. Then you've got a 50% difference between this week's implied volatility and next week's. That's what you want. You want to be able to capture that big drop in this week's implied volatility when earnings comes out. Now, historically, and this is a tricky part, I actually have a piece of software that finds this, but historically, the stock should move less than the expected move at least 80% of the time. Now, the market makers have a percentage move that they're expecting on the stock, all right? And they always do that. Every time earnings comes out, they have a particular percentage move, and you can always tell just by looking at the money calls and puts, and you can tell what they're expecting it to move. What we look for is historical information on any individual stock that shows that these particular stocks did not exceed the expected move more than 20% of the time. The less, the better. If they fall within the range 90% of the time, you've got a much better chance of making money on it. 80% is good. You don't want to be taking a stock that beats earnings 50%, beats the earnings move, not earnings. We don't care what the earnings are. What we care about is the stock price move. We don't want to be in something that beats that percentage gain or percentage loss. We don't want that one that's like does it 50% of the time. We only want it to be 20, 10% of the time, 15% of the time. That's what I look for, and that's important because that's a critical thing. And then we enter the trade the afternoon prior to tonight or tomorrow morning's earnings release, and we close the trade for profit after the market opens, if possible, for 20 to 40% profit. If the stock moves more than the expected move, if they're expecting a 10% move and it moves 20%, then we're probably going to be trapped in the trade a little bit, and then we have to make a decision as to how to handle this, which I can do. I mean, I can if it's going up, I can buy some additional calls and ride those up and close the trade out. And if it's going down, I can do a couple things. I can buy some puts on it if I think it's going to continue down, or I can just let this week's calls expire worthless, hold next week's calls, and look for a bounce in the stock. So it depends on what I determine the technicals look like in that particular stock. But that's how this time spread works. And again, it's the only strategy I use over earnings. We've had tremendous success with this thing over the last 2.5 years. except about 85 to 90% win rate. I showed you the results we've had so far this year. You don't get a lot of these. I mean, we're only talking about in earnings seasons, it might be 2 or 3 in a week. I have to, you have to have earnings, and B, it has to meet our criteria. But it's a really nice portion of our room and our alert service, because we're also doing put credit spreads, we're doing straight calls, we're doing straight puts. The alerts will give you alerts on all of those. So we have several strategies that we use here, and you would get alerted on. But this is one I wanted to focus on, because a lot of people are always talking about, how to beat earnings, how to trade earnings. They're doing straddles and strangles, etc. But the problem is, if you're going to do a straddle or a strangle on an option move, it's got to exceed what the market makers are expecting. Otherwise, you're not going to have enough. You're not going to have enough of a move in the stock to break even on it. So this is much more reliable than doing any other type of trade on earnings, in my opinion. Okay, so that's how it's done. I'm going to try something quickly here. Let me just drop this down. So I just want to show you this. This is Thinkorswim, but any account is the same. It doesn't really make any difference. But let's say this is Groupon, for example. Let's just say and this is their head-for earnings, but let's just say you wanted to do a time spread on Groupon. So what you're doing is you're looking at the price is $12.59, so you'd be using $12.50. This is a $12.50 strike. So what you do is you go over here and you just click on this, okay, and you're going to buy. And what you're going to buy a calendar. They call it a calendar. And what you see is what it's going to produce here. It's buying the $12.50 calls expiring next week, 28th, and it's selling the calls expiring this week, the 22nd, this coming Friday. So this is, if you just do a buy calendar spread, that'll automatically load that in there. It's showing you that it's costing you 13 cents, which is low because the earnings are over. But this is what when you put it on, this would be your total risk. So that's how you do this in a TOS platform. I know that other people use a lot of different platforms. I don't use Thinkorswim to trade with, but I just wanted to show that because so many people do. So that's the video for tonight on time spreads. Again, this is the kind of results we've had with these things this year. This is fairly common. We do these a lot. So if you become a member of the room, become a member of the alert service, you'll get to see a lot of time spreads. And one of the nice things about time spread is, if you are under PDT rules, pattern day trader rules, where you don't have $25,000 in your account, so you can't make more than 3 trades in a week, in 5 days, unless you have a cash account. But if you don't, then these will not count against your day trades, because they're put on one day and close out the next day. Don't count as a day trade. Neither do the credit spreads that we do, the put credit spreads. Those also are over time, so they don't count. So even if you don't have a $5,000 or $10,000 account and you can only do 3 trades in a week, you're going to get a lot of trades that are not going to impact that for you, because they'll be overnight trades, which means they don't count against the day trades. All right, so that's what I wanted to cover tonight. They're called time spreads. It's the only way, as far as I'm concerned, to make money over earnings. If you become a member of the room or the alert service, you'll start getting these. It might be 1 or 2 in the next couple of weeks, but we will ramp them up in April as earnings start to pick up. Then we'll have a lot more. All right, so listen, I appreciate you listening to the video, and I hope you'll take a hard look at these time spreads. I think it's something that if you're not used to using or you haven't used before, I think you're going to find them very, very useful. All right, thanks much.